Are you in the market to buy or sell a home? There are tricks of the trade you need to know about.
Yeah, Dan the Mortgage Guy is here to help, and he showed up on his birthday. Hey, happy birthday.
Thank you very much. Good stuff coming ahead, you guys. We're going to be talking about the mortgage industry's dirty little secret, what most mortgage lenders don't want you to know.
All right, 9:43 now. Whether you're in the market to buy or sell a home, it can be daunting.
Dan the Mortgage Man is back with us with the biggest dirty little secret in the mortgage industry, and I guess that's that mortgages are not always what they seem.
Yes, looks can be very deceiving. You really have to read the small print and pay attention to everything you get in the mail or even see on TV. The phone's constantly ringing in the evening. We all know it's a lot of times mortgage providers trying to lower our payments. The big secret that's been going on for a long time is really the fleecing of a lot of consumers out there through the form of a option arm mortgage or what they call a pick-a-pay mortgage. This is called a negative amortization mortgages. And these mortgages are very dangerous when you get one of them because your mortgage balance actually builds and goes up rather than being paid down. It's not a good thing.
Explain negative amortization, exactly how that works.
Well, you know what? I figured you were going to ask me that, so if it's all right, I brought a little board here. I can whip it out visually for you guys and really show you there for the camera there.
Okay.
But amortization means, like on a 30-year fixed mortgage, this is your mortgage balance where you start right here. And as you pay even payments over a 15, 20, or 30-year period, your mortgage balance naturally goes down at a fixed rate. This is the kind of loan you want. I don't care how long it is. 40 years is okay too, or 50 years, but your payment savings only goes down like $100 even for adding 10 or 20 years. So I don't like those either. I like a 30-year fix. That's the best way to do it. This is amortization, meaning even payments of principal and interest to repay the loan. Negative amortization is the reverse. It's the opposite of amortization. So very visually there for you. This is what happens on a negative amortization loan. Your balance actually builds. You end up paying a partial payment, and the other rest of your payment, which is usually equal to the same amount, gets added onto your or heaped onto your mortgage balance, and then the next month when you make a payment, you pay on your old principal plus half of your payment from the month before, and so forth and so on until the mortgage builds to about 125 to 110% of its original value. So this is a very, very scary thing. Buyer need to beware on this.
Definitely look for those terms. All right, you say beware of terms like fixed payments, but fixed sounds good.
Fixed sounds really good, especially when we do, like, I brought some more things to show you, especially when we do fixed at 1%.
Hey, that's great.
Sign me up.
1% or
I'll take that.
How about 1.95? I don't know if you can see 1. I love it. Where do I sign up?
I know.
Oh, look at this one. Take a look at this one.
Look how happy they are.
Look how happy they're actually jumping in the air. I don't know if we can get it now. Notice by the 1.95 it says payment rate. Not interest rate, payment rate. It's a negative amortization mortgage. You're not paying all you owe. You're stacking it on, paying interest on what you used to owe plus what you owe now, stacking it on, stacking it on, stacking it on, stacking it on. And guess what? After 5 years, the stacking stops. Then you have to pay full principal and interest. So talk about payment shock. A lot of homeowners out there are going to see their payments jump 75 to 100%. These are not good loans. And then, well, let's talk about some of the points that I have because there's some tips that you need to be aware of.
Know the true rate.
Yes, so we saw the 1% and the 1.95. I had a consumer call me and say, I don't need your help. I've got a 2.5% fixed for 30 years. I said, sir, you don't. Come in, I'll take your picture, put it up on the wall, because it doesn't exist. He came in, his actual interest rate is 7.9. So the rate is calculated by an index and a margin. If you look at one of these loans, you must know your index and your margin. An index is just a financial indicator tracking the cost of money all over the world, like the prime rate. So index plus margin, your rate, not the 1%. And some of these rates are 7 and 8%, and people think they have a 1% 30-year fixed mortgage, but they don't.
Okay, watch the prepayment penalty or term.
This is really the part that makes me really, I don't want to say violently ill, but pretty close to it. These prepayment penalties are an optional feature. They do nothing for the consumer. All they do is going to raise your margin and make more money for your loan officer or your mortgage provider. So it sickens me that these borrowers are stuck in these loans. When the rate starts to get out of hand, they want to refinance. They have a 3-year prepayment penalty. If you look at these loans, you don't have to have a prepayment penalty. They're available in 0 or even a 1-year prepayment penalty. So with no prepayment penalty or 1, the only reason to go to 3 is to raise your margin and your rate, and your loan officer is going to make a lot more money, unfortunately. So buyer, really beware on these loans.
All right, you say no long-term plans.
These loans are a good loan for investors because they're a cash flow vehicle. You can control a lot of real estate for very little payment. But after 5 years, they reset. So this is a very short-term solution. If you're going to use it as a bridge loan to move into a new house or upgrade or move away, they're okay for 2 to 5 years to have a very low payment. But you still owe it anyways. In fact, you owe more because you're putting the rest of the payment you don't pay on there. And one last thing, these rates adjust every month. That's what's so bad. They call it fixed payments at 1%. This is actually a monthly variable loan, the worst kind.
Right.
Other variable loans are fixed for 2 or 5 years or 7 years. These are variable from month 1.
Right.
And they trail the economy by 9 months. And since prime has gone up 18 times in the last 2 years, there's a lot of shock and a lot of hurt coming for homeowners out there that have these loans.
So what's the best? What's fixed rate going for right now? 30-year fixed or 40-year fixed? Or 40-year, 50-year? I can't even get it.
Yeah, the 40 and 50-year folks, just stay away from them. Your payment goes down like $100 to pay 10 extra years. Just look at the good old-fashioned 30-year. And those rates for well-heeled borrowers can be down in the low 6s. So for you, I'm sure I could get 6.1 maybe, okay? They're in the mid to upper 6s depending on the program and credit and LTV and some other guidelines, of course. But they're still an attractive bargain historically.
I remember when getting 9.5 was a good rate back in the 90s, in the early.
In the year 2000, the rates were 8%, and people forget about that. And all these variable loans.
When 12 was a deal. So,
yeah, well, 17% I've heard before my generation, but can you imagine?
No,
17%.
Do you think it'll stay right around there for a while?
You know, most experts, including myself, do predict that by the end of the year we'll see rates at 7%. Obviously, with the global economy and all the terror and things like that, things can happen to the financial markets, but we do see rising rates for the future. And even rates in the 7 for mortgages isn't too bad. Still a good bargain, the one the 30-year fixed. That's what I'm telling all my clients.
Okay. All right. Very good. Dan, the mortgage man. We'll have you back soon. Thanks. Good info.
Thank you.
Well, say goodbye to unripe fruit in your fridge. There's a new way to